Greetings everybody and welcome back to class, and in this video we're going to talk about standard deductions versus itemizing. Let's hit it. All right, everybody. So in this video, basically what we're going to do is we're going to talk about the standard deduction available to individuals. Then we're also going to talk a little bit about standardized versus itemizing and when you would do one versus the other. And then we're also going to talk about some strategies in using itemization. So before we get kind of to what the difference is here, what are we talking about? So the IRS basically says, look, or not IRS, Congress, and the tax system basically says, look, for everybody that's out there, there's a certain amount of income that everybody needs just for basic needs, food, water, whatever, living expenses, blah, blah, so on and so forth. And they're going to determine a certain, and again, they did, lots of research, lots of negotiations, try to figure stuff out. And originally the idea with the standard deduction was that's the income that we really don't want to tax. So it's going to be the first blank amount of income that it is. Now you have to understand, long ago, the standard deduction was very low. I mean, we're only talking like a few $1,000s. And then over time, it kind of got bigger and bigger and bigger. And then roughly, well, with the Tax Cuts and Jobs Act, what they did is they said, look, there's a standard deduction, which, households have. And then they have a personal exemption, which is sort of the minimum cost that somebody needs in order to be able to survive. So what they were going to do is take those two numbers together. And that's the level of income that you receive tax-free before they're going to start doing taxation. Now, Tax Cuts and Jobs Act comes around, and what they did is they wanted to suspend personal exemptions. Okay, and so they got rid of personal exemptions under the Tax Cuts and Jobs Act. I believe they're suspended until 26. And then what they did is they took the standard deduction, they doubled it. Now you might say, well, if and the standard deduction plus the personal exemption for a married filing joint family was almost equal to what the standard deduction was plus the exemptions. And you're kind of like, well, wait a minute, why would they get rid of personal exemptions and double the standard deduction? So regardless of whether you itemize or standard deduct, you got the personal exemption. By merging the two together, what they've done is they said, look, households are going to get X number of dollars, and I can't remember what the number is for this year. It's around $12,000-$13,000. Okay, for an individual, and then it's double that for married filing joint. And they basically said if you want to itemize, you have to go above that. Okay, so the problem that kind of creates is, if we're going to take itemized deduction, which is everything we covered in the second video, and you take, the standard deduction, you're going to take the larger of the two. Generally, you're going to want to take the larger of the two. And the way they did this whole scheme, and I don't mean scheme like they're being evil or anything of that nature. Scheme more in the European sense that it's just a thing that exists. But in the scheme of this, what ends up happening is that in order to be able to take the itemized deduction, it's becoming more and more difficult. Now, you might say, well, why would they want that? If people take the standard deduction, what ends up happening is that that's free. There's no way to audit that. You get the standard deduction. There's no auditing of that. And so the IRS really likes it because if people take standard deductions, there's no questioning of it. Okay, so that's why it can be very valuable for that standard deduction, and that's why when they did the Tax Cuts and Jobs Act building, one of the goals that they had was to get the number of people who are itemizing down below 20%. It used to be at around 31, 33. They wanted to get it below 20%. The reason why was because the IRS was spending a lot of time and money and resources trying to audit the itemized deductions. And so the way that it's sort of been, manipulated and devised, it's it's very difficult to itemize anymore compared to how it used to be in the past. And if you're retired where you've got a higher standard deduction, it's even worse. We'll talk about how standard deductions work here, and we'll talk about itemized deductions. But I wanted to give you that background before we got into this, because understanding why the standard deduction is there and how it works and how the itemized deduction works and how these two work together and things of that nature can be very important to tax planning. And we'll talk about how that works there. All right, so standard deduction. Okay, well, actually, here are the numbers. I should have known it was on this slide. So if you are single in 2023, you get a standard deduction of $13,850. Now, what that means is that if we take all of your Schedule A deductions, we add them up, and this doesn't include Schedule 1 deductions. Schedule 1 deductions are given to you regardless of whether you itemize or you standard deduct. Doesn't matter. That's why they're more valuable, because you don't have to choose either or. You get those. With the itemized deductions, we're going to take either your standard deduction of $13,850, or if your itemized deductions are greater than $13,850, we'll give you the itemized deductions on that sense. All right. But if you think about it, and by the way, take a look at a Schedule A. And if you take a look at a Schedule A, remember, a single person, the max that they can take for a SALT deduction is $10,000, right? SALT, state and local tax. Max is $10,000. So $10,000 minus $13,850, and that means they have to have $3,850 in other deductions. That can only come from really three other sources, generally for most people. And that's going to be medical deductions, it's going to be home interest deductions, or it's going to be charitable donations. And most single people, if you're single and young, you're probably not giving away $4,000 to whatever organization, or maybe you are. Maybe you're a very generous person. You want to do that. It's fine. Okay. But generally, that's not going to be the case. And if you're married filing joint, that's $27,700. But remember, the SALT limitation is $10,000 whether you're married filing joint or single. So for a married filing joint person, they have to have interest, medical deductions, or charitable donations above $17,700. So unless you really own your own home, it's gotten to the point where you're not going to get that. If you rent, you're going to be a standard deduction person, unless you're just giving gobs and gobs of money away to charity. Because most people will never get over the medical floor of 7.5%. Okay. Now, you'll notice there that they say additional standard deduction for age and or blindness at the end of the year. So if you're over the age, and I believe it's 65, if you're over 65, what happens is they'll add $1,500 to your standard deduction number for each spouse. So if, two taxpayers 70 years old, they're going to get to add another $3,000 to that. So it's $30,700. And that's one reason why when it comes to our retired clients, most of them have already paid off their house. Most of them have, they'll do charity donations, but they don't necessarily do enough in order to be able to get to the itemized level. And we don't encourage our clients to use the charitable deductions. We call it chasing deductions, where they're like, oh, I'm going to give $10,000 to this organization because I like it and I want a tax deduction. Don't do it because you want the tax deduction. Give it if that's what you want to do. We'll see if we can get a way to make it valuable on your taxes. But don't say, well, I'm gonna do another $5,000 on top of that because I want to get that deduction. It generally doesn't work out that way. Okay, so from a tax planning, tax strategy sort of standpoint, again, if you're renting, you're almost always going to be standard deduction, and there's not much we can really do about that. Okay. Now, mind you, with the additional standard deduction for age and blindness, if you're both over the age and blind, that's $1,500 each. So theoretically, two 70-year-olds who are married to each other that are both blind would not get $3,000. They'd get $6,000. And that would make it even harder to have that. Again, in that case, more likely than not, well, I don't want to make judgments, but the fact of the matter is that in that case, normally there's going to be a lot of medical expenses and things of that nature, but it's still going to be very hard to get over that $33,000 threshold. And this is just going to get worse and worse and worse over time because as inflation goes up, these numbers increase. Okay. So, like I said, when you go through the tax returns and you get to the adjusted gross income, then you're going to get to your deductions line. That deduction is either going to be the standard deduction, as it's listed here, or it's going to be the itemized deduction, as listed in Schedule A, whichever is higher. All right? Now, you could force somebody to do a standard deduction, even if the itemized is more. I've only had one time in my history where I even thought about that. And it was actually because we were amending a tax return, and then we were looking at it saying, gosh, and there was a carryover issue that we were worried about him having to pick up income for. It's a very advanced topic. I don't want to even get into it. But more likely than not, you're going to take the higher of the two and move on. Okay. Now, for individuals' claims that depend on another return, the standard deduction is the greater of $1,250 or $400 plus earned income not to exceed the standard deduction amount of those who are not dependents. Now, where you're going to run into problems with this is usually like, and where I've seen this in the past, college kids who have rich parents that have been giving them investment money over the years. Sometimes we call these trust fund kids. So what ends up happening, because you notice that it says $1,250 or $400 plus earned income. Okay, so say for example, you got a kid who's got $750,000 portfolio that's generating roughly about $10,000 to $15,000 of dividend and interest income every year. Okay, that's not income that's going to make it's earned income, which means interest and dividends aren't earned income. So what'll happen in that case for that taxpayer, the $1,250 would be their standard deduction, and then they're going to pay tax on everything above and beyond that if they're still a dependent of their father and mother. Now, another case about that though, that's going to be subject to what's called the kiddie tax, and we don't talk about that much in this class. But kiddie tax is essentially where and by the way, that is actually the term. If you look at the form, they'll call it the kiddie tax. Okay, and when I say kiddie, Kiddie, okay, like kids. Okay, what they're trying to say, and what they're trying to do with the kiddie tax is prevent income shifting, so that mom and dad have all this money, they shift it to the kids who have a low tax rate and they don't have to pay as much in taxes. So under the kiddie tax, if you meet certain guidelines and $12,000, $15,000 of dividend income, they'll hit it. They're not taxed at their tax rate. They're taxed at their parents' tax rate. So it's doubly so. Number one, they don't get a full standard deduction. And second of all, they're getting hit with a pretty bad tax. So that's why, there's 100 different ways to do this. And we probably would have done this differently for them if we had that. But again, I inherited that client that we were talking about. Okay, a strategy that we've done in the past is bunching itemized deductions for tax benefits. So what do we mean by this? We've had in the past where, for example, I actually had a client this actually happened to. They had cancer, and they beat it. And I mean, good on them for it. But they ended up paying a lot of the expenses out of pocket, and I won't get into the reasons why. So they had this huge medical expense tax deduction they were going to get this year. All legit, everything was lining up. Plus their standard SALT tax, $10,000, plus they had their home. And so what ended up happening was, we said, and normally these are they're retired clients, so they normally don't itemize. But because of this huge medical expense that they had to go through because of the cancer, they were like, okay, we're going to itemize this year. And I said, that's okay. And they contacted me in November. They were smart. And they said, what do we want to do with this? And I said, And I knew these people pretty well. They're church-going people. And I said, how much money are you giving to the church every year? And they said, oh, about 10 grand. And I said, how would your church feel if you gave 20 grand this year and didn't give next year? They'd probably be happy with that. So what we did is we said, look, before December, if you have the money to do so, why don't you pop another $10,000 on top of what you would normally give? We can take the tax deduction this year, and then when you go back to being a standard deduction next year, you can go back to giving money, but you don't, whatever. And they said, well, that's sound planning. So sometimes when you get kicked into the itemized deduction or kicked out of the itemized deduction, there's opportunities to do some bunching in order to say we're going to take some advantage of this. And prior to this, the idea of doing the donation, because of the medical expenses, they were already going to be itemizing. We said, okay, good, let's take advantage of this. Okay, and again, sometimes just some smart planning at the right time would be good. If you take it and you used to live in a house where you're automatically getting itemized deductions because you have all this interest that you're paying, and then you leave the house and you go into a rental for a little while, you'll probably get into the standard deduction. In that year of transition, there's some planning that you can do in order to take advantage of the tax situation before you go back into the standard deduction, and then charitable donations really don't get you any good. Okay, so there's definitely a lot of stuff that we can do for our clients now again. This is kind of on us, but it's really on the clients to know that they need to reach out to us at the end of the year to talk to us. So sometimes I'll have clients who don't, and that I can't do anything about this at that time. Okay, so that's why it's important for us to emphasize to our clients that they got to reach out to us very frequently. All right, folks, so that's the video on standard deduction versus itemized deduction. I hope you got a lot out of it. And if you have any questions, please reach out to me, and I look forward to seeing you in class.